these red flags may not always mean that there is a fraud or company is manipulating or siphoning of money. It just means that there is something unusual in that company and we need to investigate further. Sometimes management might have a valid explanation for the red flags. Sometimes there may not be a fraud, but management might be just trying to, buy some time and hide some problems. Or in worst cases, there could be a serious problem and management might be, engaged in a serious fraud. But again, in each case, we'll have to investigate further, do your own analysis and reach to your own conclusion. Again, the cases which I will be explaining are solely for the informational purpose. They do not mean that any of these companies is engaged in outright fraud or anything like that. So common accounting manipulations or financial shenanigans generally form part of the three types. So there are the earnings manipulation, balance sheet manipulation, or cash flow manipulations. In earnings manipulation, company will try to show more profits or more sales. They'll try to adjust their profits. In balance sheet manipulation, they will show more assets. They will show lower liabilities, or again misclassify just to show a rosier picture. And again, in cash flow manipulations, as we discussed, what matters most is the cash flow from operating activity. How much is your cash profits? So sometimes companies may try to show some financing activity or some investing activity as cash flow from operating activity. So basically, in all these manipulations, companies will try to show a rosier or better picture than what is already there. With that, let's deep dive into some of the accounting manipulation. So first is earning manipulation, that is the most obvious. In earnings manipulation, what will companies try to do is they will try to show more revenues. To do that, they will either record their revenues too soon before company has actually completed the transaction, or sometimes they will just show outright bogus revenues. For example, let's say in January 2020. If you booked a hotel for a vacation in April, you might have also paid the hotel the advance amount, but the transaction isn't complete yet. You are supposed to enjoy the hotel services, or you are supposed to use those services in April. So even if company has received the cash, the transaction is not yet complete. So they should record the revenue only in April. If immediately in January they record those revenues, that is recording it too soon. And the problem with that is, again, as I mentioned, the service isn't completed. They will have to give the service in April. And there is also a possibility that if you don't avail that service, they might also have to issue the refund. That is one indicator. And second is, even if there is no sale, even if there are no customers, companies sometimes will just outright, report higher revenue or bogus revenue. So how will you investigate that? So to do that, I think I will advise everyone to read the notes to accounts. In notes to accounts, companies have to disclose how is their revenue recognition policy. How do they record the revenues? So read the revenue recognition policy, try to understand, is it fair in the context of that business? Is it line with the industry peers? Then second, and I think most important indicator is the cash flows and accrual profit. So if company is recording bogus revenues, or if it is recording revenues too soon, most likely they would not receive it in cash. So there will be higher receivables. Receivables is the amount which company is supposed to receive from its customers. Customers who have not paid for the services or sales made, they are parked in the receivables, and those receivables are shown on company's balance sheet. So if company is reporting false revenues, most likely that will be accompanied by increasing receivables on the balance sheet. And second, we should also check operating cash flows versus net profit. Again, since those receivables are on the balance sheet, since company hasn't received the money, the accounting profit in profit and loss account will be higher, but there will not be cash profits. So the difference between accounting and cash profits is also an indicator that there might be some problem with company's revenue recognition. Let's look at an example. So here I have an extract of a company's revenue recognition policy. So what this company says is that income from lease rent and maintenance contracts is booked on entering into the contract. Revenue from internet services is recognized on the basis of actual billing. But the ideal policy here should be income from lease rent or maintenance contracts should be recognized over a period of the service. Let's say you recharge your mobile phone for 12 months because you got some good deal or something. But when you recharge your phone for 12 months today, the company shouldn't recognize the entire revenue for 12 months immediately because there are an obligation to provide service for over next 12 months. So ideally, that revenue should be recognized proportionately over the 12 months. That is the ideal revenue recognition policy, which this company hasn't followed. The next policy is even more interesting. What company says is that company sales turnover include cost of self-assembled and integrated capital equipment and cost of in-house developed software. The same has been capitalized and included in fixed assets as computer and plant. So basically what they are saying is that they sell computers and equipments to themselves. So sales turnover should only include sales made to the third parties. Cost of capital equipment and in-house developed software, which they have used, they have capitalized as fixed assets. That is fine, but the second effect of that should go to cost of goods sold. So whatever is the cost of developing that software or equipment, they should reduce it from their cost of goods sold and not include it as a revenue. So these were quite unusual revenue recognition policies for a company. And in that company, if you see the receivables, also they were quite high. So generally, for a normal business which offers maybe 60 to 90 days of credit, they will have 20 to 30% of their sales outstanding in the receivables. But in this company, if you see, their receivables were consistently above 50% of the sales. In 2003, it was 88%. That meant 88% of the sales which they have made, they hadn't received in cash. 88% of the customers was yet to pay them. And that is a very risky business. If your customers are not paying you, then why are you even doing the business? How will you make payments to your own suppliers? And if you see their cash profits, that is operating cash flow versus net profit, it was consistently lower than the net profit. So these were the good indicators that there might be some problem with companies' revenue recognition policy. So from revenue inflation, let's move to the inflating profits. So similar to reporting higher revenues, companies also have an incentive to report higher profits to indicate that they are doing better or have better margins and performance. So how can they do that? Is maybe by reporting one-time income or one-time gain as part of their regular business activities. They could shift some of their current expenses or future expenses to current period or future period just to adjust the earnings, or outright hide or not report some of those expenses. Again, if we want to investigate that, what we can do is compare each expense item in the annual report or P&L with previous year. If there is any unusual movement, we should investigate further. Secondly, what we can do for all major expense items, we can list them down and we can compare those items as a percentage of sales. How much it is as a percentage of sales and how much that percentage is moving over a period of time. So generally, for if there is a decline in any expense, the indicators or the reasons could be company might be capitalizing some expense. Instead of expensing it out to the P&L, company might be shifting that expense to the balance sheet. There could be one-time items which company might have netted off against the gross expenses, or company might have changed some accounting policy. These are the common reasons why generally expenses decline. Let us look at some of the examples. So this is an Indian company, and if you see in 2005 in the first table, they reported 30% revenue growth. And in that period, their operating profit margin, the margin is their operating profit divided by sales. How much is the margin or markup they can earn on their products. So their operating profit margin increased from 10.9% to 26.1%. and net profit margin increased from 8.5% to 19%. So the margins more than doubled. And again, in subsequent years, 2006 and 7, if you see, margins again went back to the previous level. So that was something unusual. And in 2005's annual report, I could not find any explanation for that. But in 2006, when they had to report a 5% revenue decline, and again the margin declined from 26% to 13%. There, in that year's annual report, they had a management explanation saying that the 2005's figures included a one-time subsidiary issued by a UK operation, and that is why in 2006, since that one-time subsidiary was not there, the revenue as well as profits were lower. So basically, in 2005, they misguided the public, making them believe that this 30% sales growth or this 26% margin was sustainable. Whereas when we adjust for that, when we remove that one-time gain, actually 2005's numbers are mostly in line with the other years. Then what I was talking about is a common size statement. So here is another company. I have noted down most important expense for the company. And if you observe their advertisement expense, in 2015, it was 69 million. From that, it increased to 255 million. From that, it increased to 468 million. But in 2017, it declined from 468 to 173. From that to 31, and in 1921. As a percentage of sales, if we see that, because business expense may keep change, but as the scale of business changes, so we should also look at these expenses as a percentage of sales. That is common size statement. So in the below table, if you see that the advertisement spend was 14.5% of sales in 2015, 19% in 2016, but in 17 it dropped to 5%, 5.5%. And in 2019, it was just 0.4% of the sales. So that is unusual. Either you need advertisement expense, so you incur advertisement every year, or if you don't need it, don't incur it. But I cannot understand a valid reason why a business would have to spend 15% or 19% on advertisement in 1 or 2 years and then completely stop spending on the advertisement. So again, this calls for a further investigation. So it either means that the expense which they made in 2015-16 wasn't required, or right now that expense is still required and they are not investing sufficiently in that advertisement expense. I always get skeptical whenever there is a reduction in any discretionary expense. So expenses like advertisement or R&D, they are not discretionary. Management can decide how much they want to spend, and the effects of them are not immediate. So if management cuts down on advertisement or R&D expense, they may immediately report a better profit. But these expenses are important for the business long-term performance. To continuously build that brand, to continuously come up with new products and services, businesses have to invest in R&D and advertisement. If they stop investing sufficiently in those areas, then eventually the business will decline. So that is why be skeptical, especially if the margin improvement or the better profits are coming from reduction in any discretionary expenses by the management. So after that, now let's move to the another trick which management have is smoothing the earnings. What happens is market appreciates the consistency or predictability of earnings and returns. So that is why sometimes companies might smooth out their earnings. So businesses are many times cyclical, that is part and parcel of the business. But then sometimes management would try to even out those cycles. In good years, they might keep some provision aside to use it in the bad years, or sometimes in the bad years it's anywhere bad year, so management may recognize all sorts of expenses. So in subsequent years they will not have to record those expenses. So if management is trying to adjust future profitability by taking some charges or actions today, that is called smoothing of earnings. One such example is big bath accounting. So especially in the bad years or bad period, or for example the latest corona or last March 20 type of situation, Anyway, the market is negative about the company because of maybe high expenses or the external market environment. Stock price might have already crashed. So sometimes management, what they might think is that अभी price तो already गया ही है, so अभी पूरा हाथ धो लेते हैं. So all extra expenses, provisions they will make in that year. They will report a worse profit. But since they have cleaned up their books or सब साफ सफाई हो गया है, उसके बाद सब accounts अच्छे दिखेंगे. So here is an example again, one of the companies in India in March 2020 quarter, they recognize a huge impairment expense. So impairment is basically whatever assets you have, you reduce the value of it. You might record that asset on 100 rupees on your balance sheet, but then you realize that the value of that asset is not 100 rupees anymore. If you try to sell it in the market today, it might only get you 50 rupees. Or the present value of future class. So the real worth of that asset is hardly 50 rupees. Then company will recognize that 50 rupees of impairment by reducing that value of that asset. What happens is, if that is a depreciable asset, that if company has to recognize that asset over a long period of time, then if you have reduced the value of that asset in subsequent years, the depreciation charge which you take on that asset reduces. So you can, since future expense is reduced because you have recognized all of that expense in the year 0, future profitability improves. And that is what happened with this particular company. In March 2020 quarter, what they did is recognize huge impairment charge that was close to 6.4 billion rupees by writing of goodwill as well as intangibles on the books. So this amount which they wrote off was 44% of the total amount which they had spent on acquiring different businesses till then, and that represented 22% of the shareholders' net worth. Because of taking this charge, the shareholders' net worth or book value, which we call it, reduced by 22%. And what has happened? The customer relations, which were part of those intangibles, were depreciable. The whatever amount they had paid for the customer relations, they were supposed to charge it to their income statement over a period of some years. But since they impaired those, the future impairment charge for the customer relations reduced by 153 million. And this was a thin margin business. So because of this reduction, they saved 153 million of charge next year. And that boosted their return on equity by 2.2%. If they hadn't taken that impairment, they would have had to amortize that customer relationship next year, and so the profit margin without that impairment would have been 3.72%. That's a very thin margin. But because of this impairment, the profit margin increased to 3.86%. That is 14 basis point increase. And the ROE, because there was substantial reduction in the net worth, increased from 7.96% to 10.2%. That is almost 25% jump from the previously reported 8% ROE. So whenever we see any such huge write-offs or large expenses, losses which are discretionary in nature, we should always be skeptical whether management is trying to smooth their earnings. These were some examples of earnings manipulation. Now let me look at some of the questions and then we'll move to the balance sheet manipulation. So one question is, accounting policies are based on Ind AS. Non-compliances should ideally be reported by the auditors. The key is to read the auditor's report. Yes, auditor's report is also useful, but unfortunately, in my experience, auditors have sometimes failed to do their job. And generally, if something is part of auditor's report, when auditors recognize or report it, it's sometimes quite late. The stock price would already be corrected for that. So the best way is to not just depend on the auditors, but also do your own due diligence. Again, you can go to company's balance website. They will have to have report quarterly results, annual reports, and the audit report will also be part of those entities. Promoters quality, yes, that's an important question. I'll address that. So now let's go to the balance sheet manipulation. That also partly talks about the promoters quality as well. So in balance sheet manipulations, what companies will try to do is try to show they have better assets. Again, no, by not recognizing the true value of their assets. Some property might be worth 50 rupees, but they might continue showing it at 100 rupees. That is by not recognizing the impairment. They might show just fictitious assets which are not at all there. The serious problem with the balance sheet manipulations is they might be diverting their company's assets to the related parties legitimately. Then another problem with balance sheet manipulations is hiding liabilities. So either not showing the liabilities, shifting them offline or off the balance sheet, or window dressing and trying to report better picture than what actually it is. If you want to investigate that, again, read annual reports, read notes to, and try to understand, does it make sense or not. For example, if there is a cash reported on balance sheet, then check what is the yield on those cash. If company has a cash, they must have kept it in savings account, or at least hopefully would have made some FD. So are they earning at least FD returns, or whatever are the market returns on the reported cash or not? If they have already reported cash, then and still if they are raising new capital, then again that's a question. If you have a cash, why are you raising new capital for it? Also look for the contingent liabilities. Lot of especially tax related or litigation or other issues might be hidden under contingent liabilities, and suddenly one day if that contingent liability materializes, company may have to pay huge amounts for that. Check what is the average cost of debt. A funny example is, well, I was working on one of the companies, and so I checked what was the cost of debt. So to check the cost of debts, what I do, I take what is the average interest expense, and I divide it by what is the average debt reported on the balance sheet. So that company had average cost of debt of between 25 to 30%. We know in India the rates are around maybe 10 to 12%. So either this company's financial position was so pathetic that they had to borrow at 26 to 30%, or the second or more possible reason could be they were just window dressing their balance sheets. On the year end, they might be reporting lower debt, but throughout the year, the debt levels might be very high. And that might be the reason why they have no higher cost of debt. So just compute these basic ratios, and if they don't make sense to you, that's a big red flag. Then neatly observe the related party transactions. A lot of times companies place corporate deposits with related parties, provide some additional services. Again, try to understand whether it is get a reasonable terms or not, and try to see if there are any unusual items in the balance sheet. My PPT is not clear. Maybe please bear with me for the poor maybe internet connection. I'll try to explain whatever I am saying. So here I have an example of a Singapore-based company. So these are the extracts from the balance sheet. So they have reported cash and cash equivalents in the range of maybe 35 million to 93 million over the years. And those cash and cash equivalents were as a percentage of net worth more than 60-70% in almost all the years. In 2017, they had 93 million of cash, and that was 72% of the net worth. So 72% of the shareholders' investment was just lying ideal in the cash and cash equivalents, not generating any significant business or revenue for the company. Some of that cash, that is 50% of the cash, was not even earning any interest. Company had themselves admitted that this was non-interest earning cash. And in spite of having such a large cash on balance sheet, they were hardly paying any dividend. The dividend payout was in the range of 30 to 40%. So if you have excess cash, just return it to the shareholders, right? And especially if you're not even earning anything on that. So let's see what was the return they were earning on that cash. So the interest and dividend income which they have reported in income statement, if we compare that with the cash and cash equivalents which they had, so the yield on their investments or cash was barely 1%. If you're not just even earning 1% on the cash which you're holding, and that cash is 70% of your total net worth, better pay it back to the shareholders, let them decide what they want to do with the cash, and you could also have better returns. But still, company continued holding that cash on their balance sheet. The more interesting or tricky part comes next. In spite of having 93 billion cash on the million cash on the balance sheet, they still raise further capital. If you see in 2014, they raised 2 million in debt and had 3 million additional equity infusion. They issued shares to the public for worth 3 million. Again in 2016, they raised 7 million of debt. So if you look at the first table, in that period 14 to 15, the average cash balance which they were reporting was in the range of 30 to 40 million. 30-40 million पैसा है और ये 2-3 million 7 million market से उठा रहे हैं. And what was the reason provided? That for the expansion purpose. They wanted to expand their business. ठीक है, expand करना. But if you look at the subsequent years, the capital expenditure, which is generally the expansion related expenditure, that was hardly, in 2014 it was 1.2 million, in 2015 it was 1.2 million, 16 mein bada hua, in 2016 they spent 12.3 million on capital expenditure. That was the same year they also raised 7 million in debt. In subsequent years also 2.6 million. So whatever was the capital expenditure, that was significantly lower than whatever cash they already had on balance sheet. You had a cash on balance sheet, it is not generating any income for you. You are not even returning that cash to your shareholders. In spite of having that cash, you are raising new money from the market. So that makes no sense. So it either means that whatever cash company reported was not there, or that was locked and was not utilizable, or something else. So this is quite puzzling and a big red flag for me. Another problem with balance sheet manipulations is the related party transactions. Companies generally treat sometimes money as their own and freely distribute it to the related parties. Luckily, because of the regulatory requirement, they do have to report all related party transactions. But and these are legitimate company. It's not a fraud or anything. That's a questionable corporate governance, but it is allowed by law as long as they properly reported. So let's look at one of the company. So a lot of companies lease out premises or properties from the promoter group or families. So similarly, this company has also done that. So they have leased out some property from the promoters, and against that property, सबको security deposit तो देना ही पड़ता है. Similarly, this company also gave a securities deposit, which was 1.5 billion. ठीक है, but rent कितना है? 88 million every year. So the deposit which they have paid against the rent is 17 times. When I try to rent out my flat, मुझे 2 महीने या 6 महीने का maximum deposit मिलता है. But this company generously paid next 17 years rent as a securities deposit. So again, that makes me wonder what is the financial logic of this transaction. There is another such example, this is a funny example. It's an MNC company. They have several subsidiaries in India. One is listed, other companies are privately held by the parent company. And if you see the loans which they have given to their employees, which are in the 500 to 600 million range, and as a percentage of the total assets which the company has, they are hardly 4 to 5 million, not a significant portion. But if you just observe or compare the loans outstanding versus the employee cost which they have reported, they are more than 50% of the total employee cost. So if we say that these outstanding or advances to employees are paid equally to each employee, that means that the employees are getting 6 months of salary in advance. Again, that makes no business sense for me. So there is a possibility that these advances might be paid to employees of the fellow subsidiaries or the sister concerns as well, or there might be something else. But again, that needs to be investigated further. Another such unusual item is, this company, they had high advances for advertisement. And in the initial years, if you see, those advances for advertisement was significant part of the total assets. Large part of your assets were stuck in those advances. But if you compare those advances to companies actually advertisement or sales promotion cost, they were significantly higher than what company was expensing. So if you see the 2013, 14, 15 advance 300 to 200 million, company would have to wait for 4 to 5 years to completely recover that advance. The advance to total advertisement cost or total SGA cost was no more than 1 times, 2 times in lot of the years. So again, that's skeptical. Why is this company paying next 4 years worth of advertisement cost in advance right now? Again, using uh, shareholders' money. So these are again, some questionable transactions. So to sum up, I would say the signs of poor quality of earnings are these accounting red flags that we saw. If there is any excess managerial remuneration, if there are excess related party transactions, if there is a complex company structure, there are frequent changes in auditors, there are very few independent directors, all of these indicate a questionable quality of earnings and we should investigate further.